If you doubled your income tomorrow, it probably wouldn't make you wealthy. That's uncomfortable to hear, but it's true. I've seen people earn more every year and remain stuck. I've seen others with modest incomes build real capital over time. The separating line wasn't brilliance. It wasn't timing. It wasn't access. It was behavior. 5 quiet habits changed my financial trajectory. None of them were dramatic. All of them were structural. And once they were in place, the math began working in my favor. There's a misconception about financial progress that I believed for a long time. I used to think that if my income increased enough, everything else would solve itself. That at some point, money would simply become easier. That once I crossed a certain threshold, wealth would take care of itself. That's not how it works. What actually changed my financial trajectory wasn't a dramatic raise, a lucky investment, or some brilliant insight. It was a handful of behavioral shifts that compounded quietly over years. They weren't exciting. They weren't complicated. But they were structural, and structural changes create permanent outcomes. The first habit was this: I stopped seeing money as spending power and started seeing it as capital. That sounds simple, but it changes everything. Most people look at income and subconsciously translate it into lifestyle. Bigger paycheck means bigger car, better apartment, nicer vacations. The math happens automatically. But when you start seeing money as capital, the question shifts. Instead of asking, "What can I afford?" you begin asking, "What can this produce?" Capital isn't meant to be admired. It's meant to work. Every dollar has 2 potential futures. It can be consumed once, or it can be deployed to generate more dollars. Once I internalized that trade-off, spending began to feel different. It wasn't about deprivation. It was about opportunity cost. A dinner out isn't just a dinner. It's the compounded value of that money over decades. A lifestyle upgrade isn't just comfort. It's capital permanently removed from production. You don't have to eliminate enjoyment, but you do have to understand the exchange you're making. That single shift from consumer thinking to capital allocation thinking changed my behavior more than any spreadsheet ever could. The second habit was learning to tolerate inaction. Activity feels productive. Movement feels intelligent, especially in investing. But markets reward patience far more than they reward constant decision-making. Early on, I made the mistake of believing that being active meant being disciplined, monitoring positions constantly, reacting to news, making adjustments. Over time, I realized that most of my better results came from fewer decisions, not more. Once I understood a business, its economics, its durability, its management, the best move was often to let time do the work. Compounding needs stillness. Every interruption resets momentum. Every emotional reaction introduces friction. The ability to sit quietly while others feel urgency is not natural. It has to be developed, and it's far more valuable than clever analysis. The third habit was refusing to let lifestyle rise at the same speed as income. This is where many people lose without realizing it. As earnings increase, expenses expand to absorb the difference. There's always a justification, a slightly better neighborhood, a newer car, a more impressive standard of living. But if income growth is matched dollar for dollar with expense growth, capital never accumulates meaningfully. I made a rule: raises increase investments first, lifestyle second. That gap, the difference between what you earn and what you commit to recurring expenses, is where wealth lives. If that gap widens consistently, capital compounds. If it stays flat, you stay dependent on your paycheck. Lifestyle inflation feels harmless because it happens gradually, but over a decade it erases millions in potential capital. Restraint isn't about denial. It's about flexibility. The lower your fixed obligations, the stronger your position during downturns, and the greater your ability to act when opportunity appears. The fourth habit was thinking in terms of businesses, not prices. It's easy to look at a ticker and see movement. Up 2%, down 5%. Volatility commands attention. But a business doesn't change value minute by minute. Its earning power changes slowly. Its competitive position evolves gradually. When I stopped focusing on price fluctuations and started focusing on business quality, something interesting happened. Volatility became less threatening. A price decline didn't automatically signal danger. It signaled a need to reassess fundamentals. Often, nothing meaningful had changed at all. Separating price from value is not instinctive. It's learned. And once learned, it creates emotional distance from market noise. That distance protects judgment. The fifth habit was prioritizing downside protection over upside excitement. It's tempting to chase big returns. It's seductive to imagine doubling money quickly, but large losses destroy compounding far more than moderate gains accelerate it. Avoiding catastrophic mistakes matters more than finding spectacular winners. That meant avoiding leverage, avoiding speculation in areas I didn't understand, avoiding concentration in fragile ideas. It meant asking not, how much can this make? But, what happens if I'm wrong? If you consistently avoid ruin, average decisions compound surprisingly well. There's something counterintuitive about wealth building. It rarely feels dramatic in the moment. It feels slow. It feels repetitive. It feels almost boring. But repetition is the mechanism. Capital compounds mathematically. Discipline compounds behaviorally. Small advantages, lower expenses, fewer emotional trades, better allocation, stack over years. The trajectory shifts not because of a single breakthrough, but because direction becomes consistent. When these habits became automatic, decisions simplified. Fewer internal debates, fewer impulsive reactions, more clarity, and clarity reduces error. Most people search for the next idea, the next opportunity, the next shortcut. But the real shift happens when behavior stabilizes. Think like an allocator, not a spender. Let time work without interference. Control fixed costs. Evaluate businesses, not noise. Protect against permanent loss. Nothing dramatic. But over a long enough horizon, these habits don't just improve results, they change trajectory entirely.